The online student.
Designed for the May 2026 session, IB Economics Higher Level, Paper 3, Markscheme. A1. Calculate the annual income tax to be paid by Sahandra. 2 marks. Using the progressive tax brackets in Table 1, the calculation of the annual income tax paid by Sahandra is as follows. Therefore, calculation of total income tax equals 0 plus 30,000 plus 120,000 plus 180,000 plus 720,000 equals MGA 1,050,000. Award 1 mark for any valid working, for example, correctly calculating the tax for at least one progressive bracket. An answer of MGA 1,050,000 without working is sufficient for 1 mark.
A2. Calculate the VAT paid by Sahandra per year. 2 marks.
To calculate the VAT paid by Sahandra, we must first determine her disposable income and her subsequent spending on VAT taxable goods. Calculate Sahandra's disposable income, YD. YD equals gross income minus income tax paid, using result from A1. YD equals 10,800,000 minus 1,050,000 equals MGA 9,750,000. Calculate taxable spending. Sahandra spends 70% of her disposable income. Total spending equals 9,750,000 times 0.70 equals MGA 6,825,000. Calculate VAT paid. In Madagascar, the VAT rate is 20%. Since VAT is an add-on tax included in the final price of goods, it is calculated as follows, assuming all spending is on VAT-inclusive goods. VAT paid equals spending times VAT divided by 1 plus VAT, where VAT equals 0.20, 20%. VAT paid equals 6,825,000 times 0.2 divided by 1.20. VAT paid equals MGA 1,137,500. Award 1 mark for any valid working, for example, correctly determining disposable income or identifying 70% of YD as the spending base. An answer of 1,137,500 without working is sufficient for 1 mark. Own figure rule, OFR, applies if the candidate uses their incorrect income tax figure from A1.
A3. Calculate the average rate of tax, including both direct and indirect tax, paid by Revo and Sahandra.
To calculate the average rate of tax for Revo and Sahandra, divide the total tax paid, direct plus indirect, by their respective gross annual incomes and express the result as a percentage. Calculations for Revo. Revo's total tax paid is already provided in Table 2. Gross income, MGA, 5,400,000. Total tax paid, MGA, 886,500. Average tax rate, 886,500 divided by 5,400,000 times 100 equals 16.42%. Calculations for Sahandra. Sahandra's total tax is the sum of her income tax from A1 and VAT from A2. Gross income, MGA, 10,800,000. Income tax paid, MGA, 1,050,000 from A1. VAT paid, MGA, 1,137,500 from A2. Total tax paid, 1,050,000 plus 1,137,500 equals 2,187,500. Average tax rate, 2,187,500 divided by 10,800,000 times 100 equals 20.25%. Award 1 mark each for the correct average tax rate for Revo and Sahandra, respectively. Award 1 mark for any valid working for Sahandra, For example, correctly summing direct and indirect taxes. Own figure rule applies if the candidate uses their incorrect income tax figure from parts A1 and A2. Percentages should be rounded to 2 decimal places. A4. Referring to the change in Madagascar's Gini coefficient shown in Figure 1, outline one possible reason for this change. 2 marks. Based on Figure 1, the Gini coefficient for Madagascar increased from 38.9 in 2005 to 42.6 in 2023, indicating a rise in income inequality. One possible reason for this change is the disproportionate impact of climate shocks and economic volatility on rural populations. Frequent cyclones and the collapse of international vanilla prices primarily reduce the incomes of small-scale agricultural farmers, while urban dwellers or those in the services sector may remain more insulated. This divergence in income stability between rural and urban sectors pushes the Lorenz curve further away from the line of absolute equality, thereby increasing the Gini coefficient. Award 1 mark for identifying that the Gini coefficient has increased, signaling greater income inequality. Award 1 mark for an appropriate explanation of a reason, such as climate shocks, cyclones destroying rural livelihoods and widening the gap between rural and urban incomes. Collapse in vanilla prices, specifically affecting the income of poor rural households. Structural challenges or uneven economic growth that benefits the industrial/service sectors more than the agricultural sector. A5. Explain the likely impact on Madagascar's Gini coefficient if the government increased the rate of VAT on basic food items, currently exempt, to 20% in 2026, 4 marks. Increasing the VAT rate on basic food items from 0% to 20% in 2026 would likely increase Madagascar's Gini coefficient, signifying a rise in income inequality. Regressive nature of VAT. VAT is inherently a regressive tax because lower-income households spend a significantly larger proportion of their total income on consumption, especially on basic necessities, compared to higher-income households. By removing the exemption on basic food, the government disproportionately increases the tax burden on the poor, who cannot easily reduce their consumption of these essential goods. Impact on disposable income. For families like Rivos from Table 2, who already spend 90% of their disposable income, this policy would lead to a substantial decrease in their real disposable income. In contrast, wealthier individuals like Sahandra, who spend only 70% of their income, would see a smaller percentage of their total wealth consumed by this price increase. As the real purchasing power of the poor falls more sharply than that of the rich, the gap between them widens, pushing the Lorenz curve further from the line of equality and raising the Gini coefficient. Possible mark allocation. Award 1 mark for stating that the Gini coefficient will increase, or income inequality will rise. Award 1 mark for identifying VAT as a regressive tax. Award 1 mark for explaining that lower-income households spend a higher percentage of their income on basic food items than higher-income households. Award 1 mark for concluding that the real disposable income of the poor will fall more significantly, widening the income gap. Accept any other reasonable answer. A6, using Table 3, Table 4, and Figure 2, comment on the view that the collapse of the vanilla market contributes to economic vulnerability in Madagascar. 4 marks. The collapse of the vanilla market significantly exacerbates Madagascar's economic vulnerability by destabilizing both its national export revenues and the livelihoods of rural households. Possible responses. National export and revenue vulnerability. According to Table 3, while export volume surged from 2,350 tons in 2023 to 4,300 tons in 2024, the total export value plummeted from $587 million to just $215 million. This indicates that the price elasticity of demand for Madagascar's vanilla might be relatively inelastic, PED less than 1. The large increase in supply shown in Figure 2 led to a more than proportionate fall in price, severely reducing total export earnings. This loss in revenue weakens the country's current account balance and reduces the government's ability to fund essential services through export taxes. Household and social vulnerability. The market collapse has direct social consequences, as approximately 200,000 smallholder farmers depend on vanilla for their primary income. Table 4 highlights that vanilla products are a niche consumption item even among urban youth. Nearly 45% do not consume them at all, suggesting that domestic demand cannot absorb the oversupply caused by external shocks or peak production. As prices fall below production costs, farmers face increased poverty and food insecurity, potentially leading to rural-urban migration and a further widening of the income inequality noted in Figure 1.
Possible mark allocation. Award 1 mark for noting that export volume increased, but total export value or revenue significantly decreased, referencing Table 3. Award 1 mark for identifying that demand for vanilla is price inelastic, meaning a supply-driven price drop leads to lower total revenue. Award 1 mark for explaining that this reduction in export earnings weakens the current account or GDP and government tax revenue. Award 1 mark for referencing the impact on livelihoods of the 200,000 small farmers or the lack of domestic demand, Table 4, to buffer international price shocks. A7. Using this information, draw the marginal social cost (MSC) curve on Figure 2, 1 mark.
Award 1 mark for drawing the correct MSC curve as shown. A8. Using your answer to Part 7, calculate the welfare loss to Madagascar resulting from excessive vanilla production in 2024, 2 marks.
To calculate the welfare loss resulting from the overproduction of vanilla in 2024, we use the area of the welfare loss triangle associated with a negative externality of production. Identification of variables. QM equals 26 million kilograms. QS equals 15 million kilograms. PM equals $140 per kilogram, Figure 2. PS equals $220 per kilogram. Answer from A7. Marginal social cost at QS and PS equals 1/2 times base times height equals 1/2 times 11 million kilograms times $150 equals $825 million. Award 1 mark for stating the answer of $825 million. Own figure rule applies from candidate's answer from A7. B. Using the data provided and your knowledge of economics, recommend a policy which the Malagasy government could introduce to help protect the incomes and livelihoods of agricultural farmers and reduce the volatility of the country's export earnings. 10 marks. Recommend. Present an advisable course of action with appropriate evidence or reason in relation to a given situation, problem, or issue. Possible policy recommendation. Implementation of a buffer stock scheme or minimum support price (MSP) for vanilla. A policy where the government or a state-run marketing board sets a minimum price for vanilla and intervenes by purchasing surplus production during years of oversupply, for example 2024, and releasing stocks during years of low supply. Expected benefits of the policy. Income stabilization for rural households. By setting a price floor above the market clearing price during a collapse, for example above $140 per kilogram, the government ensures that the 200,000 smallholder farmers receive a living income. This prevents a sharp rise in the Gini coefficient by protecting the poorest households from the regressive effects of price volatility, maintaining their purchasing power for basic necessities. Macroeconomic stability and export earnings. Stabilizing the price of vanilla, which accounts for a significant portion of Madagascar's GDP, reduces the volatility of total export value. More predictable foreign exchange earnings improve the current account balance and allow for more consistent government budgeting and investment in infrastructure, reducing the country's overall economic vulnerability. Costs and difficulties in implementation. Fiscal burden and opportunity costs. Purchasing surplus vanilla, for example 17 million kilograms surplus in 2024, requires significant immediate liquidity and the construction of specialized climate-controlled storage facilities to prevent perishability. In a developing economy like Madagascar, the funds required for this intervention have a high opportunity cost, potentially diverting money away from essential services like healthcare, education, or climate-resilient infrastructure. market inefficiencies and governance risks. Guaranteed prices can lead to moral hazard, where farmers continue to overproduce vanilla rather than diversifying into more stable crops, worsening the negative externalities mentioned in the data. State-run marketing boards are susceptible to corruption, mismanagement, or capture by powerful interests, which could lead to farmers not receiving payments on time or the fund becoming insolvent during prolonged price slumps. Alternative policies for consideration. Agricultural insurance schemes. Partnering with international organizations to provide index-based insurance that payouts automatically during cyclones or price collapses. Export diversification. Subsidies or credit for farmers to transition into other high-value crops, for example cocoa or spices, to reduce the 7% GDP reliance on a single commodity. VAT exemptions on inputs. Providing tax relief on fertilizers and tools to lower the marginal private cost for farmers, offsetting some of the income lost from low market prices. Accept any reasonable answer.
Remember to like, share, comment, and subscribe.